Welcome to Key Points for April. This month, while we think global growth will be good, but going to be less than we had expected, our take on the interest rate cycle and why market pricing is perhaps too aggressive, and we do a deeper dive this month into the credit markets. So turning to growth. Growth dynamics still looking pretty good, but as you know, we expected it to be on a declining trajectory over the course of this year. Now, unfortunately, the tragic events in Ukraine are going to exacerbate that. The elevated inflation rates that we're seeing, particularly around gas prices and oil prices, will take their toll. But importantly, there are other key commodities that are being impacted. Palladium, which goes into catalytic converters, and of course potash, which goes into fertilizers, have seen really a meaningful and scary rise in prices over recent months. And that will have an impact in terms of inflation going forward. Now, we think it's going to be higher and remain at an elevated level, but we do think it's likely to peak in the second half of this year. But there's no doubt it will have an impact in terms of consumption. Consumers are likely to find that their general shopping basket, the things they buy on a regular basis, food prices, gasoline, heating their houses, are seeing a significant rise in price that far outstrips any kind of wage gains they're getting. In other words, there is a squeeze on real disposable income. And of course, that means they have got less money to spend on other items that are non-essential. Now, the starting point is still reasonably good. Remember, we've alluded to the fact that the savings rates have been high over the last couple of years, and consumers in the developed world economies have quite a lot of cash on their balance sheet. So they do have some cushion, at least, to offset some of these higher prices. But it will undoubtedly impact consumption, and as a result of that, we have lowered our growth forecast somewhat, particularly in the case of the Eurozone. Now that takes us to our second point around the policy environment. Now, these very high levels of inflation have forced the hand of the central banks. The Fed moved rates by 25 basis points, as we had expected at their last meeting, but the market pricing suggests that they're going to be doing 7, 8, or even 9 further rate hikes over the course of this year. Now, we think that's probably too aggressive. Yes, the Fed has been behind the curve, and they may need to play a bit of catch-up, perhaps moving interest rates by 50 basis points at their next meeting. But thereafter, I think they have to have a light touch. Further rate hikes will be forthcoming, but with the growth dynamic beginning to slow, fiscal headwinds are quite significant, and if we're right in terms of the inflation dynamic beginning to improve in the second half of this year, we think there's going to be a more cautious approach that is required. Of course, it's difficult for these global central banks. Distortions remain from the pandemic, and of course the war is complicating things further. So we think they need to be pragmatic in terms of the timing and the pace of rate hikes that they enact. Now, turning to the financial markets, we showed last month a chart about the S&P 500, how it does prior to wars and in the 6 months thereafter. And I'm showing you an updated version of that. You can see it's following a typical kind of trajectory. In other words, investors are looking through the horrors of war, thinking that things are likely to improve going forward. And as I said last month, while we think that track is probably sustainable, there's no question the unpredictability of what's going on will have an impact, and has to be a cautious approach still is required. But this month we've gone into a little bit more detail around the credit markets. High yield credit has held up remarkably well since the start of the year. Part of that might be because it's less liquid. Investors were less able to sell that during the volatile period we've seen over the last 6 to 8 weeks. But our focus is more on the investment grade market. Spreads have widened appreciably again over the last couple of months as investors began to reduce some of their weightings and exposures. And given the fact that the corporate sector remains in still a good health, margins are high, defaults are likely to remain low for some time, we think with that spread widening, the market is beginning to look more interesting. And we go into a lot of the details around that in the paper this month, which of course, as always, is available on zurich.com/MSME.